Hey everyone, Mackenzie with HashBasis here, and in this video we're going to be looking at the accounting and tax implications of restricted token awards, RTAs for short, and what the implications are if the 83B election is not filed. Since we're here in the US, there's actually a section called Section 83B in the Internal Revenue Code, and it has some tax advantages to it. But let's say you forgot to file this election, here's how you would handle the accounting and the tax for it. So just to back up a little bit, restricted token awards, RTAs for short, are a form of token compensation. And so the founder or early employee may receive some tokens upfront as part of their compensation package, but these tokens are subject to some kind of restrictions or vesting, usually in the form of time-based restrictions, which means that, let's say the employee has to work for 4 years to receive their full award. There might be a 1-year cliff, and after that cliff is reached, maybe 25% of the award is vested. And so when the 83B election isn't taken, it presents some not challenges, but just more accounting and more tax work. If the 83B election is taken, let's talk about that for a second. It's a little bit easier because the employee is basically saying, hey, this is my total grant. Here's what the value of the grant was at the time that it was given to me, and I'm going to pay income tax, ordinary income tax on that lump sum amount. Now, if that employee leaves before the full vesting is up, then too bad for them. They're not going to get a refund on their taxes, but that's the risk you take when you take an 83B election. Now, if you don't take an 83B election, you have to pay income tax as your grant vest. So let's say you reach the 1-year cliff and a big portion of your grant vest, then you have to pay tax at the fair market value of that portion of the grant that did vest at that time. And then after that, let's say a grant vests every month, then you'd have to calculate what the fair market value of that grant is at the end of every month, and then that gets added to your total compensation, ends up on your employee W-2. So that's the whole context for the 83B election and why we're talking about that in context of restricted token awards. Tokens or crypto is considered property under the Internal Revenue Code, which is why this is coming up in the first place. So this example, just to recap, we're looking at how to do accounting and tax for restricted token award grants when the 83B election is not taken. So the entries that we're looking at here are actually from the perspective of the employer, but it's the information the employee is also going to need for their W-2. Now, the tab that I actually want to start on is this schedule tab right here, because once we walk through this, then the rest of the tabs will make sense. And so this schedule basically lays out the employee's grant and looks at the vesting schedule for the grant. So for example, we have our employee right here. Usually for these schedules, I build out what type of employment contract they're under, so US full-time equivalent. And then if there's any agreements here that we need to add, like their employment contract or the award contract, we can add that here. Now, these amounts here are pretty critical. So first part is vesting start date. So we basically need to know when does vesting start. Typically, this is the same as the grant date. So you consider this the grant date, vesting start date. The two may not always be the same. You have to read the vesting agreement or the restricted token agreement, but typically they're the same. Now, if there's a cliff, the cliff end date will be here. So most cliffs are typically a year into service period. So we have vesting start date plus 365 to get our cliff end date. And then we have our vesting end date, which is the time at which the grant is fully vested. If the employee wants to withdraw everything, they can. And so for this, I've set up basically a 4-year vesting schedule with a 1-year cliff. And so we see that reflected here. Okay, so total vesting months, we can calculate how many months this grant is actually going to vest. Now, for example, the total grant that I have here in tokens is 25,000. And so it's just any token arbitrarily. We're just saying, yep, this employee, when they started working at this company, let's say on January 1st, 2022, they were given 25,000 tokens, restricted token awards. Now, an important thing to note here is that if the 83B election isn't taken, then it's usually the onus is on the employer to actually do enough withholdings. So they can't just give the employee the total grant and say, good luck with taxes, since this grant has to be reported on the W-2. There is some responsibility to withhold taxes. Now, the way that I've seen it is that companies will withhold tokens. So in this case, let's say the total grant was 25,000 tokens. But let's say only 15,000 of that was actually deployed, and that's assuming a tax withholding rate of 39%. So one minus 39%, we get 61%, and so that's what is actually deployed. Now, there's some arguments, as to whether to do the withholding upfront or maybe every month or upon the cliff actually being reached, just because crypto prices are really volatile. So even if the company withholds 39%, which would be, in our example, roughly 9,700. Even if they withheld that amount and they converted to stable coins right away, let's say to off ramp to pay for taxes, that might not be enough, right? If crypto prices change dramatically. So all in all, definitely recommend withholding some amount, let's say 39%, but maybe not converting it to USD immediately, since the price of those tokens may change. Good to just have them in a withholding vault. Now, the vesting schedule here is what we see. Now, the vesting schedule starts on January 1st, 2023, because that's when the cliff is actually reached. So before that time has been reached, there actually is no vesting. None of the grants actually vested, so there's no income tax liability, because the grant, nothing's really happened. It's still in a state where it's vesting. Now, in our example, I've also assumed that 25% of the grant vests on the cliff date. And so if we take a look at the total amount then that vests on the cliff date is essentially the total token grant, and then multiply times 25%. Now, you notice in this schedule, what we're interested in calculating is the gross compensation to the employee, which is why I didn't take the amount that was actually deployed. We're taking the total grant because that's actually their total compensation. The amount that's actually deployed is net of withholdings. But for our purposes, we want to know, well, what's their total income, not their net income. So for January, multiply that 25,000 by 25%. And then after that big lump sum is reached, then we can assume the monthly vesting schedule, which is pretty much just the total grant and then divided by the total months of vesting. So we get a more even cadence of roughly 500 tokens being vested every month. This schedule goes on forever until basically January 2026, let's say January 1st, 2026. And so we can add up, if they stay until that date, the total amount of tokens that have vested is 25,000, which is equal to their grant right here. That's the first part. Now, the second part, which definitely pay close attention to this, is that we have to take the amount that vests every period and multiply it by the fair market value price. And so in our case, what we would want to do, let's say for January, is multiply the amount of tokens that have vested, 6250, by the price on the day that they vested. So let's say January 1st, 2023. And so that's what this amount is here. I just put in some fake pricing here. I think for my example, I did like an average price for the month. If you want to be like the most accurate, you would use the price on the date that the grant actually vests. But for my purposes, I think just to keep it simple, I use an average price. But these are just example prices here. So where the 18,000 comes from is just tokens that have vested multiplied by this $2. And it's the same thing for each of the months. And it's really interesting to see how the fair market value, the compensation changes, because it's all the same amount of tokens that are being released every period. But crypto prices are volatile, the price is going up and down, so it's changing. And that's exactly what we see reflected here. So sometimes pricing goes down, sometimes it goes back up, goes down. That's kind of the nature of crypto. Now, if we carry the schedule all the way through, the total fair market value of the total grant at the end of vesting is roughly $122,000. So that's the total value of the additional property compensation that this employee has earned if they stay until January 1st, 2026. And these amounts that you see translated to USD, this is the gross income that will need to be reported on the employee's W-2. Again, the W-2 will also reflect the taxes that were withheld and remitted to the government on behalf of the employee, which is another reason why we're looking at the gross income figures here, not the net, and why there's going to be basically a split between the total grant and then what was actually deployed and what the employee can actually withdraw on chain. Okay, now the second tab here is payroll journal. And so typically what I see with customers that have this set up, there's no 83B election that's taken, is that they do either a monthly or an annual off-cycle payroll to account for these token awards here. And so what they'll do, let's say it was just this one employee for 2023, they would sum up the total amount the employee earned. And so in this case, be 55,000 for 2023. And then that's what they run through the off-cycle payroll at let's say at the end of the year. And then the appropriate amount of taxes are calculated, withheld, and remitted on behalf of the employee to the appropriate government agencies. And to cover those taxes, the employer would then convert the amount of tokens that they had withheld to cover those taxes owed. And so that's what we see in the payroll journal right here. This is very common. You'll see these types of reports in payroll softwares like Gusto or Rippling or JustWorks. They all look very similar, but the common theme here is that you'll have to run some kind of off-cycle payroll since the amount that's paid to the employee fluctuates. Like the same amount of tokens, but pricing fluctuates, so the total amount of compensation also fluctuates. So not to get too nitty-gritty into the payroll details, we have the gross amount of earnings the employee earned. So for 2023, it's at 55K. And then we can back into the total employee taxes. I just use some example rates here. So there's FICA, Social Security, and Medicare, and then there's the actual federal income tax the employee will need to pay. This is the amount that's going to be withheld from the employee. There's some state taxes here, and then there's the employer version of the taxes, which is basically the other half of Social Security and Medicare. So overall, we get the total amount, what the payroll software calls check amount, really the net amount that's remitted to the employee. It's really just those tokens that are on chain, and then what it actually costs to the employer. Now, just to pull this all together, if we go to the journal entry tab here, these journal entries are from the perspective of the employer. So the company that's actually giving this grant out to the employee. Now, let's go ahead and cover this table first here. So this is a summary of what the employee has earned, what their total compensation is in tokens and also in USD. So for 23, it was at 55K, and then we see how it fluctuates year over year. But the total grant, again, is 25,000. That hasn't changed. Okay, now in this example, usually this comes up a lot because the crypto company is issuing their own token, and so that's what's considered the employee or the compensation to the employee. So the first journal entry here is actually reflecting that the employer has a liability to probably pay these tokens out in the future to the employees that were there early. And so typically what I recommend is this type of entry here where the company recognizes that they have restricted crypto assets, but they also recognize that there's a liability associated with those assets. So the fair market value at time of grant, so on January 1st, 2022, we're assuming that has a value of 4 cents. And so we're saying, okay, the total value of these tokens to the company, at least at the time of grant, is roughly 10K, which is where we get this number right here, the 10K. And so this comes up, one, because the employer is likely generating their own token if they're coming out with it themselves. And so we need to reflect the fact that the employer has these tokens, but then it's also liability to then give them out to the employee. Now, the second journal entry here relates to the end of year payroll journal. And so this might not be the same for your company. This is just an example, but these are just some elements to think about. So the first thing is that the employer would want to recognize a token compensation expense, which again is the fair value of the tokens that have vested in the current year. So for 2023, 55K. The employer will also need to recognize payroll taxes, which you get from the payroll journal right here. They also need to recognize the fact that since the tokens have actually, a portion of them have actually vested, they need to release some of that liability. So the way that I've done it here, and sorry, it's a little bit confusing, but first we need to look at the restricted crypto asset. So the way that I've set it up, anytime that the tokens vest is being taken out of the restricted crypto assets and we're settling the employee RTU liability because those assets are no longer the property of the company. They are completely the property of the employee since they've met the vesting restrictions. And so what I've done right here is pretty much I've just done a proportion that's looking at the total value of the tokens and then multiplying it by a proportion of how many tokens have vested for the year out of the the total tokens in general for the grant, and then splitting it between the net amount and then the tokens that are withheld. So we can say the total value of the grant to the employer at the time of the grant date was 10K, and at the end of 2023, at that same cost basis, roughly 4K of that has been invested by the employee. And so that's the same amount that if you sum these two up together, we get employee RTU liability. We're settling some of the liability because, again, the employee has spent their time here, they've settled it, they've earned those crypto assets, and we can also de-recognize crypto assets since they are the employees now. So that's that section. Now, the other piece that I have introduced here, which again, you may not necessarily have this, but I do recommend just kind of thinking about this because it gets back to what we mentioned here with the tokens that are actually withheld on behalf of the employee. So we're saying roughly 9K in total is being withheld. And what the employers typically do is they swap a portion of the withheld tokens to USD and off-ramp it to cover the payroll tax liability. And so that's exactly what you're seeing here. I'm just saying it arbitrarily. These tokens some of them were swapped for stable coins. Stable coins were worth 25K. And so we're actually just recognizing a gain between the total stable coins that were received and then the cost basis of those tokens that were withheld for taxes. And the difference is just going to be your gain loss. Now, the other parts are accrued payroll taxes payable. So basically just the federal taxes that are owed by the employee. That's going to be paid out through the pay run. So that just goes back to the payroll journal here. And then the last part, which I think is normal to have, is realized gain on settlement of the restricted token award. And this is more from the perspective of the employer, right? So when they first recorded these assets, they were roughly 0.4 cents. But the value has likely fluctuated a lot between the initial journal entry here and then when the liability was settled and the RTAs were officially transferred over to the employee. And so that's the difference that we get right here, and actually gets back to the pricing tab. I have a whole schedule here just looking at the original cost basis and then looking at what the difference between the cost basis and the pricing is for each month, the average pricing, and then that's the realized gain loss that we're calculating, plus or minus a small variance there. So that's the gain loss on the actual change in the pricing from the perspective of the employer. And so we have a journal entry here that you would, in this scenario, just book once at the end of the year. Okay, so hopefully this makes sense. I know this is super complicated, but if you don't take the 83B election, you'll have to do at least something that looks similar to this. So, okay, with that, let me know if you have any questions, and feel free to reach out to HashBasis if you need further assistance. All right, thanks so much.